Why are developers still building when the fundamentals of the market are screaming that we're heading straight for a precipice? Human stupidity is infinite, and that's exactly where I make my money. I've spent 50 years watching people fall in love with their own ideas, ignoring the cold, hard reality of a balance sheet. Today, the world is obsessed with this work-from-home fantasy, convinced that we can run a global economy from our kitchen tables. It's a delusion of epic proportions, and the bill is finally coming due. Look at the skyline of any major city. You see those cranes? Those aren't symbols of progress. They're monuments to arrogance. People are building for a world that doesn't exist anymore, while the one we're actually living in is drowning in oversupply and evaporating demand. I've always said that the most important thing in business is the fundamental law of supply and demand. It's the first thing they teach you, and it's the first thing everyone forgets when the sun is shining and the money is cheap. For the last few years, the market has been drunk on low interest rates and the hallucination that this time is different. It never is. The work-from-home trend isn't a new normal. It's a structural defect in our economic plumbing. You can't have a vibrant city if the offices are empty. You can't have a productive workforce if everyone is isolated. And you certainly can't support the trillions of dollars in commercial debt if the tenants are handing back the keys. I'm a grave dancer. That's what the press calls me, and I wear it like a badge of honor. It means I'm the guy who waits for the music to stop. It means I'm the guy who looks at a disaster and sees an opportunity to buy at a fraction of the replacement cost. Right now, the streets are starting to look like a cemetery, and I'm just getting warmed up. But before I tell you where I'm seeing the most profitable corpses in this market, and believe me, there are plenty, we need to talk about why the current crop of experts is so dangerously wrong. Most of these growth analysts you see on TV have never lived through a real cycle. They think a dip is a buying opportunity. They think a recession is something that lasts 6 months, and then we go back to the races. They don't understand the concept of capital preservation because they've never actually had their own skin in the game. They're playing with other people's money, chasing disruptive trends while ignoring the cash flow. In my world, if it doesn't cash flow, it isn't an investment. It's a prayer. And right now, the office market is full of people praying for a miracle that isn't coming. The absolute law of supply and demand is being violated on a massive scale. We have millions of square feet of office space hitting the market just as companies are realizing they can shrink their footprints by 40 or 50%. When supply goes up and demand goes down, the price doesn't just soften, it craters. But you look at the valuations being carried by some of these rats and banks, and they're still pretending it's 2019. They're using pro forma numbers and exit cap rates that are based on fantasy. They're ignoring the fact that the cost of capital has doubled while the utility of their asset has been cut in half. That is a recipe for a total wipeout. I've always been obsessed with the downside. Everyone wants to talk about the upside, the blue sky potential. I want to know how much I can lose if everything goes to hell. That's what I call the margin of safety. If you buy an office building today based on the hope that people will eventually get tired of their pajamas and come back to the cubicle, you have zero margin of safety. You're betting on a psychological shift that you can't control. I don't bet on psychology, I bet on numbers. And the numbers say that the cash flow produced by these buildings is no longer enough to service the debt. The extend and pretend era is officially ending. For the last couple of years, banks have been working with developers, pushing out maturities, hoping for a pivot from the Fed. Well, the pivot came and went, and the reality stayed the same. The buildings are empty. In 2026, we are hitting the wall. There's a massive amount of commercial mortgage-backed securities debt maturing right now, and there is no one to refinance it. The illiquidity premium that people thought they were earning in private equity has turned into an illiquidity prison. They can't get out and no one wants to get in. That's where the grave dancer comes in. I'm looking for the blood. I'm looking for the point where the denial turns into panic, when a guy has a $500 million loan coming due and the building is only worth $300 million, he has a problem. When the bank realizes they're going to have to take back a half-empty tower in a city with rising crime and a shrinking tax base, they have a problem. I am the solution to that problem, but my solution involves me buying the asset at cents on the dollar. I'm not here to save you. I'm here to buy what's left of you. The work from home delusion isn't just a real estate problem. It's an economic contagion. Think about the ecosystem that survives on the office worker. The dry cleaners, the restaurants, the parking garages, the public transit systems. When the office worker disappears, the tax base evaporates. When the tax base evaporates, the city can't provide services. When services decline, the quality of life drops and the productive people leave. It's a death spiral. And yet, you have politicians and urban planners talking about converting office to residential as if it's as easy as changing a light bulb. It's not. Most of these buildings are physically impossible to convert without spending more than the replacement cost. They are zombie assets, dead but still taking up space. I see these growth analysts talking about flexible workspaces and amenity-rich environments. They think that if you put a pickleball court on the roof, people will suddenly want to commute an hour each way again. It's nonsense. People are lazy, and if you give them the option to do less for the same pay, they'll take it every time. But eventually, the companies they work for will realize that productivity is down, culture is dead, and they're paying rent for space they don't use. That's when the big quit becomes the big layoff, and when the layoffs start, the demand for office space doesn't just shrink, it disappears. I've always looked for asymmetric risk, scenarios where the potential reward far outweighs the risk. In the current office market, the risk is entirely on the downside. If you buy now, you're catching a falling knife. There is no floor because we don't know where the bottom of the demand curve is. Is it 20% lower, 50%? Until we see companies actually mandating a return to the office and making it stick, we are flying blind. And as a guy who values capital preservation above all else, flying blind is a great way to end up as a smudge on the mountain. Look at the regional banks. They are choked with this stuff. They've been the primary lenders for these commodity office buildings in secondary markets. They don't have the capital to absorb the losses that are coming. We're going to see a wave of bank failures that will make 2008 look like a rehearsal. Why? Because in 2008, the houses were still there and people still needed a place to live. In 2026, the offices are there, but no one needs them. It's an obsolescence crisis, not just a financial one. It's like being the biggest manufacturer of buggy whips right when the Model T starts rolling off the assembly line. You can be the most efficient, most ESG compliant buggy whip maker in the world, but you're still going out of business. I find it hilarious when I hear people talk about this being a great time to buy the dip. Which dip? The one where your equity is wiped out, or the one where your mezzanine debt gets toasted? There is no dip when the fundamental utility of the asset has changed. Real estate is a simple business. You provide space in exchange for rent. If the tenant doesn't need the space, you don't have a business. You have a pile of steel and glass that requires taxes, insurance, and maintenance. It becomes a liability. I've spent my life avoiding liabilities disguised as assets. The grave dancer philosophy is about discipline. It's about being willing to sit on your hands for 5 years while everyone else is getting rich on paper. It's about being the only one with cash when the margin calls start hitting. I'm seeing the first signs of it now. The corpses are starting to pile up in the suburbs. The big campus-style offices that were so popular 10 years ago, they're ghost towns. You can buy them for the price of the land, and even then you might be overpaying because of the demolition costs. I've always believed that you make your money when you buy, not when you sell. If you buy right, the exit takes care of itself. But buying right in 2026 means having the courage to ignore the experts who are telling you that Recovery is just around the corner. It isn't. We are in a secular shift. The economy is reconfiguring itself, and the office-centric model of the last 50 years is being dismantled. The work-from-home delusion is the catalyst, but the underlying cause is a massive oversupply of unproductive capital. We've had a decade of free money, and free money creates bad habits. It creates developers who don't care about supply and demand because they can always find a greater fool to buy them out. It creates investors who don't care about cash flow because they're chasing appreciation. Well, the fools are all tapped out, and the appreciation has turned into depreciation. The illiquidity premium is now a penalty. If you're stuck in a non-traded REIT or a private fund right now, you're watching your net worth vanish in real time, and there's not a damn thing you can do about it. I'm looking for the barriers to entry. Usually that means looking for markets where it's hard to build: New York, San Francisco, London. But in 2026, the biggest barrier to entry isn't the zoning board, it's the debt market. No one is lending. If you don't have a massive balance sheet and a track record of surviving the grave, you're not getting a loan. This means the big players, the ones with the cash, are going to consolidate everything. The democratization of real estate investing through apps and platforms is over. It's going back to being a big boys game, and the big boys are looking for blood. I've often been asked how I knew when to sell. In 2007, I sold equity office properties for $39 billion. People thought I was crazy. They said I was leaving money on the table. I told them I'd rather be a year too early than a day too late. I saw the exuberant irrationality. I saw the lack of a margin of safety. I saw people buying at cap rates that didn't make sense. I'm seeing the same thing today, except instead of a boom, I'm seeing a denial boom. People are holding on, hoping for a rescue. There is no rescue. The Fed can't print a reason for people to go back to the office. The government can't legislate productivity. The reality of the 2026 bloodbath is that it's necessary. We need to clear out the zombie companies and the zombie buildings. We need to let the market find its floor, even if that floor is much lower than anyone wants to admit. Only then can we start building something that actually makes sense for the future. But in the meantime, there's a lot of money to be made dancing on those graves. I'm looking at specific sectors and specific geographies where the corpses are particularly juicy. I'm looking at the debt pieces that are being sold at fire sale prices by banks that are desperate for liquidity. Liquidity is the ultimate arbiter of value in a crisis, and right now liquidity has left the building. When the banks get scared, they don't just stop lending to the bad projects, they stop lending to everyone. That's the asymmetric risk that nobody wants to talk about. You could have a great building with a great tenant, but if your loan is up for renewal and the lender's trying to save their own skin, you're dead. This is where the real carnage starts, because it creates a forced liquidation of even the good assets. And that's exactly when I start looking for the corpses that still have a little bit of life in them. The problem with this work-from-home delusion is that it has created a massive disconnect between perceived value and actual utility. For years, we've been told that data is the new oil and that we don't need physical space because everything is in the cloud. Well, you can't live in the cloud, you can't build a culture in the cloud, and you certainly can't mentor a 22-year-old kid over a Zoom call. Companies are starting to realize that their productivity during the pandemic was just people burning through the social capital they had built up over decades of working together in person. Now that the social capital is gone, the wheels are falling off, innovation is stalling, mistakes are being made, and the CEOs who were too cowardly to demand people come back to the office are finally realizing they've sabotaged their own futures. This is why I say the economy is going to crash under the weight of this fantasy. If the office market collapses, it's not just a few rich developers getting a haircut. It's the pension funds that own the REITs. It's the insurance companies that hold the debt. It's the local governments that rely on the property taxes. If you take away the heart of the city, which is the office district, the whole body starts to fail. The restaurants that serve lunch to workers, the transit systems that carry them, the shops that depend on foot traffic, they're all part of a fragile ecosystem that is being systematically dismantled by people who think they're disrupting the world from their bedrooms. It's not disruption, it's destruction. I've always looked at the replacement cost as my North Star. If I can buy an asset for $100 a foot and it would cost $400 a foot to build it today, I'm interested. But in the current environment, even the replacement cost argument is getting tricky, because if the utility of the building is zero, the replacement cost is irrelevant. You wouldn't pay a nickel for a buggy whip factory, even if it cost $1 million to build the machines. That's what's happening to Class B and Class C office space. It's becoming industrially obsolete. The grave dancer move here isn't to buy the building and try to lease it. It's to buy the debt at such a massive discount that you can afford to hold it through the demolition and the rezoning process. I'm seeing the most profitable corpses right now in the mezzanine debt of Tier 1 cities that have been completely abandoned by the smart money. Look at San Francisco, look at parts of Chicago. The sentiment is so negative that people are running away from deals that actually have strong underlying fundamentals. I'm looking for the mission-critical buildings, the ones that house the data infrastructure, the specialized labs, or the high-security operations that literally cannot be done from home. These buildings are being caught in the general office sell-off, and the illiquidity premium you can capture there is staggering. Everyone is painting with a broad brush, saying office is dead. Well, office isn't a monolith. Some of it is dead, but some of it is just on sale. The growth analysts and the tech optimists are still trying to sell the idea that AI is going to create a new wave of demand for office space. They say these AI startups will grow so fast they'll need massive headquarters. Give me a break. These companies are being built by the same people who championed the work from home movement. They're going to stay lean, they're going to stay remote, and they're going to burn through their venture capital without ever signing a long-term lease. Betting on growth in a shrinking market is a loser's game. I'd much rather bet on the death of the over-leveraged developer who has a loan coming due and no way to pay it. You have to understand the barriers to entry in this new world. It's no longer about getting a permit, it's about having the cash to sustain a vacancy. If you don't have a massive margin of safety in your cash flow, you're just a tenant at will for your lender. The grave dancer strategy requires a stomach of iron and a balance sheet of lead. You have to be able to wait out the cycle. Most people can't. They have investors who want monthly distributions. They have banks that have loan-to-value covenants that get triggered when the market dips. I don't play that game. I want to be the one who owns the asset free and clear, or with debt so cheap and so long-term that I don't care what happens to interest rates over the next decade. The current work-from-home trend is a luxury of a bull market. When the economy really starts to hurt, and it will, the power dynamic is going to shift back to the employers. When there are 10 people for every job opening, suddenly everyone is going to remember how much they love the office. They'll be beating down the doors to show their faces and prove their value. But by then, many of these buildings will already have been lost to foreclosure. The wealth transfer will have already happened. The grave dancer will have already bought the assets from the panicked sellers and the exhausted banks. If you're looking for where to position your capital, the logic is simple. Follow the pain. Where is the most pain right now? It's in the senior debt of office-heavy regional banks. It's in the preferred equity of REITs that are being forced to cut their dividends. It's in the secondary markets where the work-from-home crowd thought they could move to and still keep their big city salaries. Those markets are about to get a very rude awakening when their employers realize they can hire someone in the Philippines for 1/10 of the price to do the same remote work. The asymmetric risk there is massive. The lifestyle move of the last 3 years is about to become a financial nightmare for millions of people. I'm focusing on capital preservation above all else. In a world of work from home delusions and this time is different arrogance, the only thing you can count on is the cold, hard reality of the numbers. If you can't see the path to cash flow within 24 months, walk away. Don't fall for the repositioning stories. Don't fall for the future growth projections. If the basis isn't right on day one, it's never going to be right. I'm looking at suburban office parks that are being sold for less than the cost of the asphalt in the parking lot. That's a corpse worth dancing on. Why? Because I can turn it into industrial, I can turn it into cold storage, or I can just sit on it until the land value alone makes me a fortune. The secret to generational wealth isn't guessing the top of the market, it's protecting yourself against the bottom. The people who are going to get rich over the next 5 years are the ones who are preparing right now to buy when the panic hits its peak. And the peak isn't here yet. We're still in the anger and bargaining phase. We haven't hit depression and acceptance yet. When you see the biggest names in real estate handing back the keys to their trophy assets and walking away without a fight, that's your signal. That's the music starting for the grave dancer. The economy is a cyclical beast, and it's currently hungry. It's going to eat the speculators, it's going to eat the work from home dreamers, and it's going to eat anyone who forgot that cash flow is king. My advice to you is to ignore the noise. Stop reading the growth reports and start reading the bankruptcy filings. That's where the truth is. That's where the opportunity is. Be the person with the liquidity when everyone else is illiquid. Be the person with the common sense when everyone else is chasing fantasies. And most importantly, be the person who isn't afraid to walk into a room full of corpses and start dancing. So here is the bottom line. Position your capital where there is a clear margin of safety. Look for assets where the replacement cost is your floor and the cash flow, even at 50% occupancy, covers your debt. If you can't find that, stay in cash. There's no shame in sitting on the sidelines while the idiots blow themselves up. In fact, it's the most profitable thing you can do. Wait for the blood to cover the streets. Wait for the banks to stop answering their phones. That's when you make your move. That's when you become a grave dancer. I want you to really think about what I've said. If you're one of those people who believes that we're never going back to the office, or that this work from home thing is the greatest invention since sliced bread, then you're exactly the kind of person I'm talking about. You're the one who's going to be providing the graves. If you think my thesis is a bunch of old school nonsense, or if you have some data-driven argument about why the office market is actually in great shape, I want to hear it. Leave a comment below. My team and I will be looking through them to see if anyone actually has a fundamental argument, or if you're all just high on the same new era illusions that have wiped out every generation of investors before you. If you want more of this crude wisdom, if you want to know how to actually survive a market crash without losing your shirt, then you know what to do. Subscribe to the channel, like the video. It's a lot cheaper than the tuition you're going to pay if you keep following the herd. I don't do this for the clout. I do it because someone needs to tell you the truth before you go over the cliff. The 2026 bloodbath has just begun, and the grave dancer is just getting his shoes shined. I'll see you at the next funeral. Would you like me to analyze another market or delve deeper into the specific metrics of distressed debt acquisition?